Welcome to the Chesalbridge Capital Market Observations Call for Thursday, December the 14th. I'm your host, Eric Jefferson, managing partner with Chesalbridge. I'm going to recap yesterday's events. I got some really good news investors were looking for. Before we get started, though, a few quick words from our legal team. With that, we can go ahead, dive right in. So, as I mentioned, big day yesterday. We had the last Federal Reserve meeting of the year. Fed Chairman Jerome Powell delivered to investors everything they wanted to hear and more. Granted, he did make it clear nobody was yet declaring victory over inflation, but the Fed president did take what was referred to as a very dovish tone when he acknowledged a lot of the progress that had been made combating inflation. Now, going into this meeting, everyone expected that the Fed, for the most part, was done hiking interest rates. Well, you never say never. They did add some additional language suggesting they are all but done. Now, that didn't come as much of a surprise. However, the real catalyst for risk on assets took place after the Fed governors published their projections, or in essence, what their expectations are for benchmark interest rates in the future. Interpreting those projections suggests three 25 basis point rate cuts in the calendar year ahead. That did come as somewhat of a surprise. Market had been pricing that in. First time, though, we've really seen the Federal Reserve come out and publicize that stance. Now, as you would imagine, we talk about the inverse relationship between interest rates and stock and bond prices. As you would expect, this was the fuel investors needed to be confident piling into those risk assets. We saw both stocks and bonds, particularly the longer duration government bonds, up double digits. A great year, or excuse me, a great trading day across the board. Furthermore, those gains continued early this morning at 8:30. We received retail sales figures that came in positive, above expectations that were flat. That suggests consumers still willing to go out and spend money, arguably the number one concern facing our economy today. So, for any clients that are in balanced models or portfolios that own some portion of bonds, roughly a month ago, we made the call to go out, add those longer duration treasury bonds. That duration nature or sensitivity, if you will, that is what works against you in a rising interest rate environment, works very much for you as interest rates are falling. In the last month or so, based on our anticipation for rates to be coming down, we have seen those positions appreciate very significantly. Now, we are in the process of putting together our 2024 outlook. I'm going to provide, as we normally do, summary recap of everything that's taken place this year, as well share our thoughts for the calendar year ahead, but do so in a slightly different format. We're actually going to go through and really just take a closer focus at what we believe will be those key issues, those key metrics, those key trends that will dictate risk performance in the year ahead. That's all for today. As always, appreciate you taking the time to tune in. And if we don't connect, have a great holiday. Take care.